Hello everyone, this is Professor Kent and today's recording is chapter 9. I already had a recording before, but I lost part B or part 2 of the chapter 9. Just to help everyone, I'm re-recording chapter 9, the example question, which you will learn the chapter by doing the example. So we're going to learn the theory and do the whole chapter. At chapter 9. So when we think of it, if you have money or if as a company has a money, you're going to invest. When you invest, there's two type of investment. There is a debt investment and there is an equity investment. How do you know which one is what? If the company buys bonds of another company, that we call it is a debt investment. If a company buys shares or stocks of another company, then we call it is an equity investment. So that's the theory behind it, but now we're going to learn each of the investments. So when we think of it, first is that we if the company, there's a company A and there's a company B. If company A buys bonds, so if it's a bond investment, and then what we call it is called a debt instrument. So bond investments are that you're investing into bonds. You're investing into bonds, you're giving somebody money. So what happens in this case, we needed to know, is this a debt investment or is an equity investment? How do we know? By looking at the question or looking at what is the contract says. They said the company buys bonds for company B. The bond pays fixed amount of interest annually for 10 years and may also be purchased through intermediary. The question is this a debt investment? Yes, it is, because what we did is company A bought bonds of company B, and what you gonna, if you invest into bonds, what are you gonna get? You have a right to interest, and you also have a right to principal. The principal that at maturity. That those are the two things that are going to happen. You're going to get an interest for 10 years. If the term is 10 years, each year, if it's an annual interest, you're going to get an interest. Also, you're going to get your principal back at the time of the maturity. The question is this a debt investment? Yes, it is. Because why? First, you're investing into bonds. The second one is you have the right to interest and you have a right to principal at the maturity. Let's go further and see if we can pinpoint what is your next investment is. Now they told you at the top it is an equity investment, but we needed to learn if this is an equity investment. It says company A invest in common shares of company B. So company A is purchasing shares of company B. So if it's a share investment, we call it's an investment and it's under equity. So the question is asking, is this an equity investment? Yes, it is. And then why is it? If you have an equity investment, what are you going to get? If you buy shares of another company, you're going to get a dividend. What else you're going to get? You're getting a voting rights depending on how much your ownership is. The other thing is you have the right of residual assets when the company closes. If the company goes bankrupt or company closes, what are you going to get? You have the rights of residual asset. Means you have assets and you have a liability. Once you pay the liabilities, the leftover assets will go to the common shareholders. Now when going further, they said how do we calculate the price of a debt instrument? If you did a liability bond liability chapter, this is the opposite. Now we're doing an investment. So now what is the fair value of the bond? When we think of a fair value, we think what is the present value of the bond. So that's of the bond investment. Now in this case, how do we I'm sure you have seen it before in your chapter. In this case they said that they assume that the 25,000 face value bond is priced at 99. So what we're looking for, what is the present value and what is the fair value of the bond? That's what we're looking for. When you're looking for the fair value of the bond, when you think of a face value of our bond is 25,000. We wanted to know what is the present value. What is this is when we this is called a face value. When we think of a present value, we're thinking of a fair value. What is the worth today? The fair, what is the present value of the bond? How do we know what is the present value? In this case, it's shown to us in a 99%. When you do that, the present value of your bond investment is 24,750. So now if I take the difference between those two, tells me if it's a discounted bond or a premium bond or a par value bond. So when the present value of your present value or the fair value of your bond is lower than the face value, it is a discounted bond investment. So if the face value is 25,000 and the question say the is priced at, so if I say it is priced at 103%, if they does that, if it's a more than 100, it will be premium. But what will be the present value? I take 25,000 multiply by 103%, and what does that give me? It gives me 25,750. So again, I am going to compare my the face value of your bond with the present value of your bond. Now this will be a premium investment in bonds. This will be a premium. The next one we're going to go to, if the face value of your 25,000, it is priced at 100%. So that means the present value of the bond, it will be what? It will be also, it's a par value bond, it will also be 25,000. If the present value and the face value is same, then we call it, it's a par value bond. So that's what that's what we do. It is called a par value bond. So you could have a discounted bond investment, par value investments, or you could have a premium bond investment. So let's go further. Now if you invest into the next one is what, of course there's a different method depending on our ownership. Again, we are going to go back to, I'm going to say I have an investment, and you can invest into a debt or you invest into an equity. So when you invest into an equity, you're investing into shares. And the first, when you buy an investment, the first method we're doing is a cost model investments, and we're going to show you how to do the transaction if it's a cost model. And how do we know we're using a cost model? The question will tell you, of course, the cost model, of course, your ownership in that other. When you purchase shares, you have ownership. What percent is your ownership? The first method we're learning is the cost method, and we're going to do the transaction, and we're going to show you how to do each transaction. So our first one, we're learning about cost. We're going to go back and forth because the book does back and forth, but at the end we're going to do something here, then we're going to go back to the debt because that's what we needed to do, what the book is doing in order. On March 8, 2023, Kwan Corporation purchased 1,000 shares of this at $4.20. What did we go? We have an investment, and this is investment in shares, and then they did not tell us how much our ownership is. We just purchased 1,000. If you purchase 1,000 shares, and we will record this investment under cost model. So when you do the transaction, my first transaction will be done on March 8th. What did we do? We purchased. What did we purchase? 1,000 shares. At what price? $4.25. That's what the price is. And then a 1.5% commission is charged on the transaction. So if the commission is charged on the investment, what we wanted to do is we wanted to know how much is the commission. So my commission will be, number of shares was 1,000 times 4.25, and then multiply by 1.5%. That's how much the commission is going to be. I don't have a calculator, and let's see if I could just use my my calculator, my phone as a calculator. 1000 times the 4.25, 4250, and this is comes out to be 64. So the total we invested into shares, and the total investment is for 4314. So of course, if you're showing it, you have to show it in, you could put it in one in the 1,000 investment. The value of the investment is 4314. So when you do you of course, when you purchase shares, you are going to give them a cash, and the cash will be 4314. Now you invested into which company? Hergy company. So what you recorded, it's recorded as other investments, and this is my credit 4314. So 4314, I'm just going to write it here so that later on it becomes easy for us to work out when you sell it, because I just wanted to make it easy for me as possible. This transaction is done on March 8th. Going further, they said on December 31st, they declare a dividend, and dividend is 10 cents. So what become, if you purchase, if your investment is into shares, what are you gonna get? You're gonna get dividend. That's what you're gonna get, dividend. Now when you do March 8th and on December 3rd, December EMB year, December 15, what did they get? The company that we purchased the investment in, they declare dividend. We own 1,000 shares, and our dividend is 10 cents. And did they pay us now? No, they just declared it. At the time you declare it, what we're going to do is we're going to be receiving a dividend receivable and the dividend revenue. How much is that? This is going to be $100. So that's my, now they said it's record and payable on January 15 comes. Now we want the money. We are going to get a cash, and we are going to get rid of our dividend receivable for the amount of $100. Now if we want to keep the investment, we keep it. If we want, don't. Now next thing is happening is on July 14th, we didn't sell everything. We sold part of the shares. So how many shares we own? We own 1,000 shares. The purchase price that the investment, we bought it for 4314. Now what we are doing is we're selling. How many shares are we selling? 800, and the price is 58, and we have to pay a commission. So we have to pay a commission. So how do we record this? First of all, when you're getting rid of it, you are going to get rid of you have to pay the commission, of course. First thing you're going to know is that the cash that you're going to pay, how much cash are we paying, and how much cash we are receiving. So when you're receiving the cash, they told us we're selling 800 shares, and the price is $5.08, but we also have to pay commission on that. So if you were to think about it, what is the commission that we're going to pay? We needed to pay a commission, and difference between those two, when you debit will be like, how much cash am I receiving? I should have brought a calculator here. I have 800 multiplied by $5.08. I supposed to receive 4,064, but top of that we paid commission. And how do we calculate the commission? There you could calculate it times 1.5%. that we have to get rid of, times 1.5%, $60.96. So we can avoid the decimals too, 4064. And the cash we are going to debit is the cash we are going to receive is, I'm just going to just skip the decimal places. 4,003. Now then we look at the other investment. How do we get the other investment? If I were to think about it, now if you were to think about it, we bought the cost of the investment was 4,314, and we bought 1,000 shares. So that's what the if I were to think about the per share cost will be, multiplied by the 800. So you could do it in one go, or first you could find out what the investment cost that is sitting in our books, and that will be 4,314 divided by 100. It's going to be $43.14, and we getting rid of 800 shares, and that will be your I have an extra zero, so it should be 4.314. So it should be 4,34314 divided by 1,000, and it's 4.314 multiplied by the 8. I have to get rid of the other investment from our books, and that will be 4.314 multiplied by the 800 shares that I'm selling. It will be worth 3,451. And then now my entry doesn't balance. Either we have a gain or we have a loss. In this case, we're getting more for our investment. We have a gain. So you could do gain slash loss of investment. So that's my invest 552. Let's go further and see if we can pinpoint what's happening with our next one. Now we are going to go to our next. Now there's I have to explain the amortized cost method when we have a debt investment. So now we said that I'm just going to go back here. You have an investment. If you invest into debt is in a form of a bond, and then we're going to be learning three things. One is an amortized cost model. We can have a fair value net income model. We can have a fair value OCI model. So what is the difference between the both? We have an ASPE company. You could be filing an ASPE or an IFRS when you have a bond investment. When you think of it, ASPE companies only can have if you have an amortized cost model. We got our amortized cost model, but the only thing is that we have a straight line. When you're amortizing your bond, you can only use straight line. You can also have an amortized cost model under IFRS, same model, but the only difference is we have to use an effective method to calculate the effective interest method. When you have an investment in the bond. So let's do first one, and then we go further with this. So in this case, we have to read the question. How was the price determined? Prepare an amortization table and the entry to record the purchase of the bond. They're only asking for the purchase of the bond. So let's see. Now we know that we have a present value, which is called a fair value of the bond, and we also have a face value of the bond, which we call it which is the face value. If now on the question, sometimes the question tells you, sometimes it doesn't. When you have a bond, what we have is there's two rates here. So what are the two rates? Let's explain those one. 8% is a coupon rate, and this is yield to maturity that decide what the fair value is. So the market rate decide the present value of the bond, or we could say the fair value of your bond investments. When you're reading the question, figure out what the question is telling us when you're reading it. What we're doing is we bought an investment. What did we pay? We paid in 92,278, and to purchase the purchase 100,000 of Chan Corporation's bond. So the face value of the bond is 100,000. We are given 8%. 8% is your coupon rate. We call it a coupon rate, or we call it a stated rate that is stated in your contract, stated rate. And then the market rate is 10% in the question. So now they're saying Robinson account for the investment at an amortized cost using an effective. So ASPE company prefer to use a straight line method to straight line interest method, but they can also use effective method. So they have a choice. They prefer to do that, but if your question tells you that they are using effective, then you have to use the effective method. Now they're saying here is now, of course, they're saying how effective method. So I'm just going to stop at this point, and then what we're going to do is we're going to show you how to calculate the present value or the fair value of the bond when you're given a question. So when you think of a question, I will say the face value of your bond is 100,000. If you are we have an investment. So what happened to your investment? We are going to get a principal, and if you're going to receive a principal, this number on your finance calculator will be 100,000. My N is important to us. We wanted to know it's maturing and when. It says let's see, we issued the bond on January 1st 2023, and it is going to be expiring on the 2028. So what happens if it's expiring on the 28th? There is 5 years. The frequency of the payments will decide what my N is going to be on the calculator. We're making 2 payments in a year, one on July 1st and one on January 1st. So N times 2, that will be my 10. I have a marker rate, they told us, which is my IY is your marker rate. Marker rate is 10%. If it's a 10, I will divide it by 2, which will be your 5. And then what we are going to do is we are going to look at my payment. What is going to be my payment? I have 100,000 is the face value of the bond. I will say face value of your bond. I should say face value. Face value of your bond multiplied by the 8%. Since we're going to be receiving 2 payments in a year, so we are going to get 4,000. So this number is a positive number, and what we're going to do is we are going to compute our present value. That present value is 92278. So put it into your calculator, you will get this number. So they're saying how was the price determined? This is how the price was determined. So they told us in the question, but that's how we determine the price. So now what the next question is asking you to do the table. I'm not going to do the full amortization table, but I'm just going to show you how to do a table, because they're asking us to do an entry on January 1st and August 31st, but our next payment is on the July, right? So let's do the payments, and then we are going to show you how to do a transaction on January 1st at the time we purchase the investment. The investment is recorded at the present value, which is the fair value. If you're investing it, the question will tell you if what type of investment is it. In this case, it's a bond investment. Are we keeping it to maturity? Yes, we're keeping it. And if it's keeping it, we call it a bond. We will record the bond at an amortization model. So how do we record the transaction? So let's record our first transaction. The present value of our investment is 9278. So what we are doing is you will debit. It's an investment in bond, so we call it bond investment at amortized cost. So where I'm just this question, I'm gonna kill two birds in one stone. Well, I'm gonna answer 9 6 together, because in 9 6 they wanted you to use a straight line method. So that's what we're going to be doing. So I am going to do this question, so I can kill both birds in one stone. I will use IFRS and I will use an ASPE. If a company uses an IFRS, they have to use an effective method, effective interest method, and interest method to amortize their discount or a premium. Under the ASPE, we prefer to use a straight line. We will prefer to use a straight line. So the same question can be answered in both under IFRS and under ASPE. So we'll do and then we are paying a cash, and that is 92278. 92278. So that's my first transaction. So what we're going to do is we are going to show you some of the transactions that we are going to do. So this will be the entry on January 1st. So if I were to record this under the ASPE, so my entry will exactly be same under here, but how you amortize changes. So if I were to do that, the present value of my investment is 92278, and the face value of our bond is 100,000. So the entry is exactly the same. So difference between those two is my discount, which I'm going to be amortizing. So we will call it bond investment at amortized cost. And we have a cash, and that is 92278. 92278. Now I am just going to show you part of the table, because they said to prepare the amortization table. I'm only going to do part of it. When you're doing part of the table, first I am going to use my effective method to record it. When you're doing it, we have a date, we have a cash that we are going to be receiving, we have an interest income, and we are amortizing either the discount or the premium, and then we have something called an amortized cost of bond. So we always start with the present value 278. So when was that? January 1st 2023. So my next payment is in this case it is when did we get this bond? All right, my first payment is July 1st 2023. Then I have January 1st 2024, but before that I have an August year end 2023. I have an August, my year end between is my 2023. So let's complete this table, and I can explain how do we calculate it. My first one is my every payment, every 6 months we're making a payment for $4,000. Now how do I calculate the interest income? When you calculate your interest income, this will use a marker rate. Our marker rate is 10%. But what we are doing is we're amortizing the discount and the interest over semi-annually. So my interest income will be calculated using the either you could do it this at divided by 2 at a 5%. My cash payment will be 4%. How do I get it? My coupon rate was 8%. 2 payments in a year, that's how I got the 4%. And if I were to do that, 100,000 is my face value, multiply by the 4%, that's how I got the 4%, the 4,000. Now when you're calculating the interest income, you calculate you calculate on the present value. So you're going to do 92278 multiply by the 5%, because it's my first semi-annual payment, will be 4614. Difference between those two is my amortization, which is 6.1. If it's a discount, if it's a discounted investment, we are going to be adding it. If it was a premium, you will be subtracting it. So one you start with a bigger number, one you started with a lower number. So when you add it, the premium, the discount to the present value, I get 92892. So then next year I will, so this is the first, I will erase it after my carrying value is 92892 times the 5%. I will get 4645, and difference between those two is 645. I will add this number to my carrying amount. That will be 93,537. So this is how we're going to be completing the table. At the end it will be 0. That's how we're going to complete the table. So the next question was to do the entries. Now we have to do the entries. We showed you how to do a table. My next entry will be for July 1st 2023. That's when we're making a payment. Now once you do the table, it makes it easy. So now if I were to think about it, I'm getting a cash. How much cash am I getting? $4,000. I'm amortizing the discount, which is 614. So I know I have to debit 614. Now bond is recorded at a present value. If you look at the amortized amount, needs to be increased to 100,000. So I will also have to debit bond investment at amortized cost, and that is my 614. And then what I'm going to credit, my credit will be my interest income. Now if I go to, now of course we showed you the table for effective method and we have to stick to the same. If I show you under the straight line is a little bit easy. We have a present value 92278. We have the face value, which is 100,000. Difference between the both is what? I have to, it's a discounted investment 92278 minus your 100,000 gives me a discount of 7722. And in this case we have an investment, and that investment is for how long? It is for how many payments in the years are, this bond is investment is for 5 years, and either you could do it in month or you could do it semi-annually. Whatever you find it easy, you could do that. In this case, if I were to do it in monthly basis, you multiply by 12 to get 60, or you could do it you could also do it 5 times the 2, which is going to be the 10. So this will, if you do that, the reason why I'm doing that, because I needed to get to August, and that will be in months. So whatever you find it easy, that's the route you're going to take. Either one is good. So let's do it with the semi-annual payments, and then we can convert it if you need it to be. Or if you find it easy, you could do it with the monthly, because it'll be a little bit easier to navigate if you want to. So if I were to do it in months, so if I were to do this in months, so if I wanted to do it in months, 7722 divided by 60, I'm amortizing 72, amortizing my discount per month. That's how much am I doing it. If I do it this way, it will be for the 6 months. So it will be in the 6 months. I'm going to show you how the answer is going to come up to be same, divided by 10. And that will be, let's do that, it will be 7722 divided by 10 gives me 772.220. I'm going to omit the 0. So if this will be the amortization for the 6 months. So if I go further, if this was in the month times the 6, if I do that 128.70 times 6, it will give me the same number. So if you were to do that, so of course this is amortization for 6 months, and this is what if you could do it in month and then you could do a 6 month, you will get the same answer. Whatever you find it easy, that's the route you're going to take. Now what I'm going to do is I needed to do an entry for the first month, so for the July 1st 2023, my debit will be my cash. That does not change. I have a bond investment at cost. I'm either way, I could take this number or I could take this number. They both are same, 772, and I will have interest income. That will be, if I add both numbers, 4772. So if the company is filing an ASPE, they will be using a straight line, and that will be their entry. So I didn't finish this entry, 4614. In this case it is 4772. Now I am going to my next one. What is my next one? They ask us to do an entry August 31st 2023. This is not the payment date, this is my year end. So this is my year end, that's what you're going to be doing. So now either this is my next payment. What I'm going to do is, this is my 6 months payment, so I have to do sorry, I'm not receiving a cash. What I will have is, I have my interest receivable. Then we have a bond investment at amortized cost, and the number here will be, I'm going to show you, and we have an interest income. Debits, the name of the account does not change, so the name of the account doesn't change. If I were to do that, I already worked out the numbers here. So but this one number was for 6 months payment, but I'm not doing a 6 months payments. How many months are gone? I only needed, so this was July, I only need this entry for 2 months, so I only need an entry for the 2 months. If I take each number, I'm going to take each number and convert it into 2 months. So I will have my interest income was 4645. I multiply by 2 over 5, and what do I get? I get 1548. That's what I get. Now if I were to go to my next one, my amortization amount was 645. I take 645, multiply by 2 over 6. What do I get? 215. If I were to do that, now what if I were to do the next one? My interest receivable is 4000 times 2 over 6. What do I get? 133. So that will be my entry. So this will be my entry, because I'm only doing it for the 2 months. What will be the 2 months? From July to August 31st. Now I am going to do the entry under the ASPE. We are going to do the entry under ASPE for my August 31st 2023 payment. So I will have a interest receivable. The entry is the only difference is here is just remembering that we have a straight line and effective. We have a bond investment at amortized cost, and we have interest income. So again, I have a 4000 was my cash payment, multiply by 2 over 6. That will give me 13333. There's two ways of doing it. I could do it 128.70 multiply by the 2 if it's monthly, but if you wanted to stick to the same, I could do 772 multiply by 2 over 6. Let's see, 772 times 2 divided by 6, I will get 257. That is the number, and I will get 1590 here. Or you could have done 128.7 times the 2 should also give you 257. Now this is how we do it. I'm going to show you one more thing here because I wanted to do an entry for did they ask for it? January 1st. I'm just going to see if they're asking for it. Prepare the journal entry for the year end August 31st. So that's what they're asking. So this is the concept. We're using a straight line and a straight line method and your effective method. Now what happens is that if you have an investment, you have a choice to sell it. When you have a choice to sell it, you want it. How do you calculate the value of the bond, and how do you record an entry when you're using an amort? So this is the next step. It's the same. It's the same question. What they're saying is, tell me what will be the entry at the time you sell it if they recorded the investment at amortized at a cost model. That's what they're doing. So now what they're doing is you have to fast forward your life, and when you fast forward your life, what you have to do is you have to keep doing this amortization table, and you have to work out a number. When are you going to work it out? At the time you sell it, and that's what you're going to do at the time you sell it. So how would you do an entry? Sometimes it becomes a little bit more challenging when you do a sale, but if you keep it consistent, it makes your life a little bit easier. So what they said is they told you in the question. What are the question is telling us? The question is saying building on put into practice for 956. Assume the Robinson Limited sells its investment to in the Chan Corporation on November 1st. So what we are doing is we needed to do an entry on November 1st, 2027. So that's what you needed to do. What are you going to do? You're going to get a cash. And what will be your cash? You're going to get a cash at a 99.75 plus the accrued interest. So that's what you're going to be doing, plus the accrued interest. So you could either have a gain or you could have a receivable. So when you do that, either you complete the table, or what you could do is we will show you how else to calculate it. So now when you're calculating it, what you're getting. So now they're asking us to sell this bond on November 1st, 2027. So there's a different way of figuring it out. Either you use the amortization method on your calculator to calculate the carrying value of your bond in your books, or you could just look at the question and then work from there. So they said that on November 1st, 27, we sold the bond at 99.75. If I were to do that, the face value of your bond is 900,000 plus the 99.75%. That gives you the value 99,750 plus the interest. So what will be the interest? So when you think of it, we make payments every January and 1st and July 1st. So we already made a payment in July 1st, but we haven't, they told us plus the accrued interest. We want to know how long the accrued interest is for. So we have the month of July, month of August, September, and the month of October. There's 4 months accrued interest. So how do I calculate the accrued interest? When you do that, we know each payment is for 4,000 for the 6 months, plus the multiply by the 4 over the 6, and that gives you 2,666. So when you do that, what we are going to do is debit the cash. The cash value will be 102,416. So that's what the value of that will be. So now, of course, if it was accrued interest, we needed to have an interest receivable account, because we needed to have a receivable in there because we had an adjusting entry. So that will be 2666. That would be my interest. So then what we needed to do is we needed a bond investment. We needed to get rid of that bond investment at amortized cost. So the value that will be 99682, and then what we needed, we have a gain slash loss on of investment, that is 68. So there's a different way of doing it. So now what you're gonna do is either you work backwards or you work forwards, whatever you wanted to do. And if I were to do is, if you could I'm just going to put it in here so you know that we calculated it. So the face value of our bond was 100,000. My payment was 4,000. that we showed you how to do it before. My N was original life was 10 years. My IY was 5. We compute your present values. Your present value is 92278. That's what the present value is. Now if you were to think about it, what we needed to do is we wanted to know what will be the carrying value on November 1st 2027. In order for us to do that, we needed to calculate the value up to July 1st 2027, just to make it easy because our payments are semi-annually. So then we will show you how to go from this point to this point. So now the only thing you're going to do is everything is going to be the same the way this is. Don't clear your calculator, plus the second on your calculator. I'm going to do it plus the second, sorry, I have to do it. So I am going to put it in my, sorry, I have to clear my calculator. Future value 4,000 is your payment, 10 is your N, 5 is your IY. Compute my present value. My this not compute, when you do compute my present value, this will be negative because we made that payment on when January 1st 2023. You're going to press the second function on your finance calculator, and then you're going to amortize, which is in the top of your present value on the calculator. So second function, amortize P1, it'll ask for P1, which is equal to 1. Enter, go down, then it is going to ask you for P2. My P2 will be 9 payments because we know that one more payment and plus some numbers that we needed to deal with it. So now enter 9, and then you're going to enter, you're going to press enter, go down, and you are going to enter. When you enter, go down, you're going to get a value of 99048. So that's the value of 08. And now what we have is that will be the payment as of July 1st 27. The carrying value of your bond will be 9940. So you could do it through the table or you could do it through the calculator. This is the only way to show you for the calculator. So if I were to do that, now this is my payment. I have one more payment to go because I needed to, the face value of our bond is 100,000. So 99048 minus your 100,000. So what we needed to do is we still have to amortize 952. From that, I amortize how many months? 4 over 6. 4 divided by 6. So I amortize 634. So 99408, the carrying value, and the 4 months will give me 99048. The value of your bond will be 99682. And what we are doing is we are canceling this bond at 102. Actually, sorry, 99. Sorry, that's accrued interest. 99750. If I want to prove it, $997.50. How I got the $68. So I know it's just the rounding. If I take the difference between those two, should be my $68, and that's what the value is, how I got the gain and loss. Again, you could go to the table, or you could kind of go through this way. Whatever you find it easy, that's the route you are going to take. I'm going to stop my recording here, and then what I'm going to do is I'm going to show you the next model, which is going to be your fair value net income model and fair value OCI models. Those are some of the things that I'm going to show you in the next video, or I can even show you here. Let's do one and then we could do the other. So now again, you have, screen is gone. So you have an investment. The investment, first what we're doing is investment is in the form of a debt. Then we did debt is when you buy in the form of bonds, and then the first model was bonds at amortized model, and I showed you how to do that under IFRS and under the ASPE. Now you could have a bond investment in the next model is fair value net income model. Everything is exactly the same. The only thing is we have one extra entry every year end that we have to do, a unrealized gain and loss entry. Again, IFRS company can have this, and an ASPE company can have this. So that's what the next question is, to record the investment at a fair value net income model. Who's going to tell us that to record this investment at fair value net income model? Your boss is going to tell you. It's management, what they wanted to decide. In the question, they will tell you this is recorded at a fair value net income model. Mostly we say that when this is, how do we record the entries? Again, everything is exactly the same. We have a present value which is equal to the fair value of your investment. We have an N, we have an IY. We still could have a payment, and we are still going to have a face value. So they told us in the question they're using an effective, and a company is an ASPE company. So that's what they're doing. Again, you will be asked to do an amortization model, but we are going to do this question using the both IFR and ASPE, and how they are different, under the both, and how do we record the transactions under both IFR and ASPE. So let's do that. And I shouldn't have cleaned that part, but that's okay. So now we know by looking at it, the present value of your bond is one that we bought was 108.11. The face value of our bond is 100,000. In this case, it is more, the present value is more, so we call it as a premium bond. This investment in the bond is a premium bond, and again, we're amortizing every 6 months, and they told us there is a premium of difference between those two. Premium is calculating the premium. So we are going to show you under both, under IFRS and under the ASPE, just a little difference, not a much difference. So we are going to show you first IFRS, then we are going to show you an ASPE. Again, we're investing. When are we investing? We're investing January 1st, 2023. And what we'll do is, this is a fair value net income model, and we are investing in bonds. So my debit will be fair value net income investment, and credit will be a cash. Again, whatever is the present value or whatever is the fair value of your investment, that will be 108,111, 108,111. The entry under both, it will be a same debit and a same credit, same debit and a same credit. We're going to be using an effective, or you could be using a straight line. So then we are going to do an entry. My next entry is July 1st, 2023, and I'm going to show an entry on December 31st too. Now we are going to go to July, so 6 months are gone by, so we have to make in this case, when you have a when you have a IFRS, we have to amortize it, but how do we record the entry for the amortization? So we're going to show you how to do that. Now if I were to use it in this case, we every what we do is all we do is when under the fair value net income borrow, this is how it's a different. What we're going to do is we only record the cash payment, and then we call it the investment income and loss. That's what we will call it. Investment income slash loss. So that's what you would do. So now if they told us it's an effective and they told us it's an ASPE, so what we're going to do is I'm just going to do cash is your 100,000, and they told us the effective rate is 8%, and the coupon rate is 10%, which makes it semi-annually to be a 5%. My cash payment is going to be 5,000. My interest income, how do we calculate interest income? 108,111 multiply by your 4%, because 8% divided by 2, that's your 4%, and that should be 4324. And difference between the both will be my amortization. In this case we have an amortization of 676, and it's an effective method because they told us in the question it's an ASPE company, but they're following an effective method. So let's go further, and then we are going to find out the carrying value amortization of a bond. We start off 1Y2011. Now under the ASPE, the entries are exactly the same what we did before under the amortization method. The only bond at an amortized cost model is only difference is in this case our cost will be $5,000, and we have a fair value net income investment that for 676, and we have an interest income that will be your 4324. But under the IFRS we only record the cash, which is you're going to be your 5,000. Your investment income or loss will be a 5,000. Now we have to go to December 31st. Since we are recording this investment at a carrying value, what we needed to do it, we have to do two entries. First for the interest portion of it, and then we have to do the bring it up to the fair value. So December 31st 23, I have to do it now. This is my first payment. That was July 1st. Now we have to go to December 31st. Again, under the, it's very easy here. I will cash, and I will have an investment income slash loss, and that will be your 5,000. That doesn't change, so that doesn't change, but your this is going to change. My cash will be 5,000. I will have to amortize some of the discount, and I will have an interest income, investment interest income. I am going to record the entry. In this case I will have to add the 676, and I will get sorry, in this case it's a premium because I need to go down to 100,000. So if this is a premium, we have to do is we have to subtract it from 108. So 108,111, I have to subtract it, and I will get a number. My number here will be, let me 107,435. And then when you go to the next one, you go 5,000 here. The value here will be 4297. Again, you are multiplying by the 4% of the carrying value. Difference between the both will be 703, and you'll get 106,732. That's what you will get. So we will have a fair value net income investment, and then we have interest income, and that will be your 4297. I will have 703, and that's what my entry is. When you do, we have to do an extra entry under both methods. If you, under both ASPE and IFRS, if it's a fair value model. So what do we need to do is we needed to know what is the value of your investment at the, where was I? Did I not put it in? So I think when I snip tooled it, I missed it. So what we needed to do is, what is the value of your investment on December 31st 2023? Let's, for example, let's say the investment of your, the fair value, since the fair value of the investment on December 31st, fair value of the investment on December 31st is 105. So that's what we, if you're recording your investment at a fair value, we needed to do an adjusting entry. If I were to do, I'm going to do a table here, and I will say fair value net income investment, because it becomes a little easy to kind of do the adjusting entry at the end. So I have a, if I post my first entry, the value of your investment under IFRS was 108.11. We didn't do any entry for this, so that's what the value. They told us in the question the value of your investment is 10500. So it went down. If it went down, how much it went down by? 311. How did I do it? Difference between those two numbers. If you look at it, I need to put a credit. What will be my credit? Fair value net income investment. That will be my credit. And what will be that credit? It will be 311. So that will be my entry of a credit. What would I debit? My debit will be my investment income slash loss. Investment income slash loss, and that will be 311. But under the ASPE, the entry will be different, or the amount will be different. And let's show you what the amount will be. If I were to do the same thing under here, investment, I started off with the same entry, right? So I started off with 108,111. I have a credit of 7676. I have a credit of 703. The value under ASPE, the value of your investment under ASPE will be 106,732, and I need a value of 105,000, and it will be a credit, and the credit will be 1732. And under the ASPE, my entry will be investment in the account is same, investment income slash loss, and credit will be your fair value net income investment for the 1732. So when you do it, in your case, if you were to make it easy, you keep a running account of it, so you know what you keep amortizing using the same table, but you needed to reach to these numbers at the end. So this is how we do fair value net income model. So now we did one for the investments. Then I'm going to go to my non-interest bearing note. So I'm going to stop here, and then I'm going to start my next recording from at 9.9. So we have a long way to go, so I will have to record another video. Thank you so much for watching my video. Thank you for subscribing to my channel, and thank you for your feedback. So what I'm going to do is I'm going to start from 9.9 for my next recording.